Welcome to Avondale Asset Management's first economic and market outlook for June 2012. This will be the first outlook that we put together, hopefully monthly, giving an overview of our view of the markets and what's going on in the economy, and I hope you enjoy. First thing to touch on is what has happened to equity markets here to date. As most people who are watching will know, the S&P 500 is round-tripped for the year, up 14% at one point during the year in the first quarter. It's now pretty much flat. It was on pace, or it had the eighth best first quarter that the S&P 500 has ever had, and is now on pace for the fifth worst second quarter that the S&P 500 has ever had, going back to 1957. So far, the movements have been extreme, but have followed seasonal and cyclical patterns, as shown by the two charts that are accompanying the chart of this year's S&P 500. It's really tracked the way that it traded in 2006, the last time we had a cycle this long, and in the last 2 years, the seasonal patterns that have been displayed in the market. Despite the fact that equity markets have been pretty choppy in 2012, we continue to see equities as an excellent place to invest incremental dollars. Valuation in equities is extremely cheap compared to the last 10 years. The earnings yield on the S&P 500 is 8%, give or take, and as a risk premium relative to treasuries today, it's above 6%, which is the highest that it's been this decade. Treasury yields and fixed income yields have fallen so low that equities look extremely attractive and are pricing in high-risk scenarios that aren't necessarily being priced into other markets. This makes equities a favorable investment should worst-case scenario happen, because risk is already priced into the asset. While our long-term view will always come back to the valuation as the primary reason to be owning equities, from a shorter-term trading perspective, there are a couple of reasons to own equities in our view as well. One, on a cyclical basis, the economy continues to be in what we feel is an expansion phase. The average economic expansion since 1857 has lasted 41 months, and the average since post-war has lasted 59. Right now we're in the 35th month of expansion since the most recent recession ended, which suggests to us that even if this were to be a shallow expansion, a shorter expansion than usual, we could still get into the 50-month range, in our opinion, which would take us another year out, a little bit over a year out, before we'd be seeing another recession. Another reason that we feel that an increased allocation to equities is a reasonable play here is that from a seasonal standpoint, the summer is typically a good time to be buying equities because the second half of the year returns to a positive level. In the last couple of years, equities have bottomed in July and August. There's no guarantee that we'll have any repeat of the last 2 years, but at any rate, over the last 20 years, this seasonality has kind of played out. The sell in May and go away that we've seen so far this year typically yields to a second half or fourth quarter rally in October, November, and December, as shown in this chart. Importantly, our view on equities is informed by our view of the fixed income markets as an opportunity cost. The alternative to investing in equities might be to invest in high yield or investment grade credit, which right now from a spread standpoint has increased slightly, the spread relative to treasuries, and is still above where it was, the spread where it was in the 06-07 period. But on an all-in yield basis, because treasuries have moved down so much in terms of yield, the investment-grade credit, BBB index, is at an all-time low. High-yield credit has reached the lows that it saw in terms of yield in the 2006-2007 time period. We feel like in this environment, if equities are discounting such a risky environment, it doesn't make sense that fixed income would be discounting a significantly less risky environment. And no matter what your view is on spreads or relative value within the fixed income markets, I think that where interest rates are on a risk-free basis, owning the government bond kind of tongue-in-cheek risk-free, but the fact that U.S. interest rates are approaching Japanese interest rates is not a comforting idea by any means, nor do I think either market is properly priced. I don't think that getting 1.5% on a 10-year bond is the adequate return relative to inflation over the next 10 years, considering how much money the Federal Reserve has printed. Likewise, I don't think that Japanese interest rates at below 1% for 10 years is really a true reflection of the risk involved in investing in that economy, given the high level of debt at the government level in Japan, which exceeds any other country in the world. As pretty much everybody knows by now, interest rates have been falling because of two main catalysts in recent months, one of which is the still unresolved European debt situation, the other one being fears of slowdown in China. The All-Country World Index shown here has performed significantly worse than the S&P 500. This index is excluding the United States, so global equities have performed significantly worse than U.S. equities. A lot of that has been driven by a stronger dollar, a strengthening dollar, which will force the price of foreign assets in general lower. Since the dollar has been such a major driver of global capital prices recently, it's important to have an understanding of where the dollar is going. And we think that it's really dollar-euro is obviously the most important cross that people are looking at. And we think that there's an important factor that people are missing in the way that they're looking at the dollar and the euro relationship. Most importantly, people are looking at the euro as weakening as surrounding the European financial crisis, that people are fleeing the euro and going to the dollar in terms of a flight to quality. We think that there's an element of that for sure, but importantly, there's also an element of the fact that the ECB balance sheet expanded rapidly in the first quarter of this year and towards the end of last year through LTRO operations. That's created a circumstance in which the relative size of the Fed's balance sheet has fallen relative to the size of the ECB balance sheet, and you would expect the dollar to strengthen in a situation like that. You can see that since 2008, when really a new monetary regime came into place where central banks were actively quantitatively easing, the dollar has fallen every time that the Fed balance sheet has expanded relative to the European balance sheet, ECB balance sheet, and the dollar has risen in value when the ECB balance sheet expands faster than the Fed's balance sheet. This is consistent with the economic theory. One of the most important factors affecting the value of the dollar is the fact that the monetary base in the Fed's balance sheet hasn't really expanded over the last year. Ever since QE2 ended, the Fed has been stimulative in terms of Operation Twist and reinvesting in mortgages, but hasn't actively increased the size of its balance sheet or the monetary base. This has created a circumstance in which commodities have moved sideways pretty much since last summer. You can see that the trading week-to-week ranges in gold and oil have been extremely affected by the week-to-week changes in the monetary base. The blue line in the top left corner being the monetary base. Oil and gold have each moved higher as the monetary base moves higher with a little bit of a lag, and have moved sideways in periods that the monetary base has moved sideways. This period is not a whole lot different. It suggests that the dollar isn't really changing much in value, and commodities supply and demand is relatively flat, meaning that commodity prices are not rising. We would expect this relationship to continue to unfold in the future, and we would be surprised to see the Fed's balance sheet certainly would not expect it to contract, and ultimately it's more likely than not that the monetary base will continue to expand if growth continues to slow. Now, offsetting our positive sentiment, of course, is the global sovereign debt problem, which continues to be a major problem, will be a major problem until global debt to GDP ratios are adjusted downward in some way, either through nominal inflation and GDP rising relative to debt, or extinguishment of debt through default. Either way, it's going to be very difficult to achieve real growth in a world in which these debt levels exist. That said, the reason that we favor equities over fixed income is consistent with this viewpoint, because the ground zero or the centerpiece of the global sovereign debt problem are debt markets, not equity markets. And if there's a market that's pricing in these problems one more than the other, clearly equity markets are pricing in the effects of sovereign debt much more than debt markets, even though debt markets will be the ones to suffer from the immediate effects of either a default or inflation. Equities are much better equipped to weather that storm, and ultimately they're priced for the storm already, whereas fixed income markets are not. So that's another major reason to be invested in equities today over fixed income. That's the whole presentation for today. If you made it this far, thank you very much for listening. Appreciate it.